Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Dt Midstream Inc. Annual Report. Dt Midstream Inc. offers a comprehensive range of services to various industries through its two main segments, pipeline and gathering. In the pipeline segment, the company provides transportation and storage of natural gas for customers, including intermediate and end users. This involves owning and operating interstate and intrastate pipelines, as well as storage systems. The gathering segment is focused on collecting natural gas from producers and delivering it to plants for treatment or further processing. The company also offers ancillary services such as compression, dehydration, gas treatment, water impoundment, transportation, disposal, and sand mining. Dt Midstream's clients include natural gas producers, local distribution companies, electric power generators, industrials, and national marketers. The company serves a diverse range of customers across the United States, providing essential infrastructure for the natural gas industry. Its services are critical to ensuring the efficient and safe transportation of natural gas from production sites to end users. Dt Midstream, Inc.'s DTM stock price has increased by over 38.52% in the past year due to several significant news events and factors. The company's record financial results for 2025, with an adjusted EBITDA of $1.138 billion, a 17% increase from 2024, have highlighted its operational strength. Additionally, Dt Midstream has demonstrated confidence in its future outlook by increasing its quarterly dividend by 7%. The company's expanded organic project backlog, reaching $3.4 billion over the next 5 years, with 75% allocated to pipeline projects, indicates substantial future growth potential. Final investment decisions on key projects, such as the expansion of Viking Gas Transmission and the next phase of its interstate pipeline modernization program, have signaled tangible progress in its infrastructure development. Dt Midstream's strong operational execution and infrastructure growth throughout 2025 have solidified its position in the expanding natural gas market. The company has provided an optimistic adjusted EBITDA guidance for 2026, projecting $1.155 billion to $1.225 billion, representing a 6% annual growth. Overall, Dt Midstream's positive performance and future prospects have contributed to its substantial stock price increase over the past year. Dt Midstream, Inc. market capitalization of $13 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Dt Midstream, Inc. holds a significant advantage in their industry. Dt Midstream, Inc. trades at a higher price-to-earnings ratio of 34 times and a higher price-to-book ratio of 2.86 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 52% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 2.66%. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline are multifaceted and influenced by various factors. On the growth side, increased volumes on pipelines due to strong demand from industrial customers and higher prices for natural gas sold into the Chicago hub market are significant contributors. Additionally, disciplined capital deployment in assets supported by strong fundamentals, as well as pursuing economically attractive opportunities, have also driven revenue growth. Furthermore, the company's ability to capitalize on asset integration and utilization opportunities, grow cash flows through long-term firm service revenue contracts, and secure new contracts such as the Blue Union Gathering contract have all contributed to revenue growth. On the other hand, revenue decline is often driven by factors such as loss of or reduction in volume from customers, deteriorating business climate, and condition of the asset. Regulatory changes that could result in changes in rates or accounting treatment also pose a risk to revenue growth. Furthermore, low natural gas prices can negatively impact revenue. However, other drivers such as increase in demand for natural gas services in key regions, connection to premium production areas, and joint venture interests in equity method investees have the potential to drive future revenue growth. Net income and profit margins. A changing landscape, the net income of a company underwent significant fluctuations between 2023, 2024, and 2025. In 2023, the net income stood at $396 million, but it decreased to $367 million in 2024, marking a decline of 7% from the previous year. However, this trend reversed in 2025, with the net income increasing by 24% to reach $454 million. The profit margins also experienced changes during this period. The net profit margin, which was 43.1% in 2023, decreased to 37.6% in 2024, a decline of 12.7%. However, it increased slightly to 36.8% in 2025. On the other hand, the operating profit margin showed a more stable trend, decreasing from 51% in 2023 to 49.9% in 2024, and then further to 49.4% in 2025. The reasons behind these changes are multifaceted. The increase in net income and profit margins in 2025 can be attributed to a decrease in cash paid for income taxes and an increase in operating income after adjustment for non-cash items. Conversely, the decline in profit margins in 2024 was due to working capital changes and dividends received from equity method investees. These factors highlight the complexities of financial performance and the need for careful analysis to understand the underlying causes of these fluctuations. The company's financial performance indicates a consistent generation of positive operating cash flow over the past 3 years. The data from various sections of the report confirms this trend, with net cash from operating activities showing significant growth in 2025 compared to previous years. In 2023 and 2024, the company generated $798 million and $763 million in operating cash flows, respectively. However, it's worth noting that a specific transaction, the Midwest Pipeline acquisition, contributed $1.2 billion to the operating cash flow in 2025. Despite this one-time boost, the overall trend of positive operating cash flow is evident. The operating cash flow summary on page 63 reinforces this conclusion, highlighting positive operating cash flows for all 3 years. This suggests that the company's operations are generating sufficient cash to support its growth and investments, indicating a strong financial position. The company's debt level has undergone significant changes over the past few years. According to the extracted summaries, the debt level has increased due to various factors such as acquisitions and other purposes. Specifically, the debt level rose from $3,319 million in 2024 to $3,324 million in 2025, indicating a slight increase of $5 million. In terms of interest expenses, there is a noticeable trend of increase over time. The net change in interest expenses decreased by $8 million from 2023 to 2024, but increased by $4 million from 2024 to 2025. Furthermore, the interest expense rose from $153 million in 2024 to $161 million in 2025, representing a 7.33% increase. Overall, both debt levels and interest expenses have shown significant changes over the past few years, indicating that the company's financial situation has become more complex and potentially riskier. Dt Midstream's management is optimistic about the company's outlook, driven by its focus on strategic growth through expansion. The company has secured long-term agreements with customers and possesses significant natural gas reserves, positioning it for future growth. Management is committed to disciplined capital deployment, prioritizing investments that meet specific criteria in terms of strategy, management skills, and expected returns. In addition to growth initiatives, Dt Midstream is also focused on improving its financial position by reducing leverage and debt repayment. The company aims to achieve net zero carbon emissions by 2050 through environmental investment decisions, including the adoption of carbon-reducing technologies. Management is actively monitoring goodwill impairment and evaluating the impact of new accounting standards on the company's consolidated financial statements. Overall, DT Midstream's strategy appears to be centered around sustainable growth, disciplined financial management, and a commitment to environmental responsibility. By prioritizing cash flows, reducing leverage, and investing in environmentally friendly technologies, the company is well-positioned for long-term success. The company's financial reports reveal a clear commitment to rewarding its shareholders through dividend payments. On multiple occasions, it is stated that the company has paid dividends to its shareholders. Specifically, on page 7, it is mentioned that the total cash dividends declared per common share was $3.28. Furthermore, pages 29 and 41 confirm this by stating that the company has indeed paid dividends to its shareholders. Additionally, page 87 provides a significant figure of $2.7 billion in dividend declarations. These references collectively demonstrate the company's practice of paying dividends to its shareholders. Concerns about inventory buildup and supply chain disruption. There are valid concerns regarding the potential for supply chain disruption in both global and domestic markets. The possibility of service interruptions or increased downtime due to expansion projects is also a pressing concern. Furthermore, unforeseen difficulties in operating in new service areas or geographic regions pose an additional risk. Moreover, there is evidence suggesting inventory buildup as a result of inefficient cash flow management. A decrease in accounts receivable and accounts payable indicates a potential issue with managing cash flow effectively, which could lead to inventory accumulation. These concerns highlight the need for careful planning and management to mitigate these risks and ensure smooth operations. That concludes the financial summary for DT Midstream Inc. Feel free to comment below, and I will be happy to answer them when possible.